Gabay is a director at Fathom and joins me now. So with that in mind, Danny, I guess you would say that inflation being above target here in the Eurozone, a temporary problem?
Not just a temporary problem, but also by very far the smaller of the two problems relative to the underlying weakness of the recovery and in particular the peripheral economies.
How do you think this divergence between the Federal Reserve and the ECB is going to play out in the markets?
Well, they're pursuing different objectives. The Fed is trying to ensure that there is a sustained recovery. The ECB has been reluctant all along to go along with the stimulus, has had a very strong view from the start, which is that first and foremost, this is a liquidity crisis. Their decision to raise interest rates last week is going to test the destruction, that theory. Many, myself included, do not think it's a liquidity crisis. I think it's a solvency crisis, and higher interest rates are going to bring that denouement closer rather than push it away.
So how is it going to impact the weaker, more vulnerable economies within the Eurozone?
Well, the arithmetic that we go through in our report, the debt arithmetic, simply doesn't work out for Greece. Even if they're able to borrow at 6, bear in mind the market currently wants 16% from Greece, but even if they could borrow at 6, their debt to GDP ratio will keep on rising, way past 100 on to 150%. The same goes for Ireland, the same goes for Portugal. They cannot generate the kind of growth required to meet the interest rates they're being asked to pay. And what we continuously argue is that this is not a sovereign bailout. This is the bailout of those who lent those sovereigns the money, namely French and German banks. And they're being asked to be repaid on very generous terms, 5.8% in Ireland's case, for example. So the inevitability of the default stems from the fact that we just don't see these countries being able to generate the growth required. It was bad enough before. Now the ECB raising rates, and not just once, making it clear there's a series coming, chokes off one of their avenues or exit routes, which was to regain competitiveness through a weaker currency. That isn't going to help either. So slowing down domestic demand in Europe, you're pushing up the euro. At the same time, these countries can't afford to pay back their debt. Some kind of restructuring seems inevitable.
You mentioned the French and the German banks being very much exposed. What does this mean for the risk of contagion?
Well, the markets for now seem to have decided Spain is off the hook, but I don't understand why, in a sense that if you just look at Spain in its own right, fundamentals, it looks affordable. It looks like it could do what's required. It's not going to be easy. They still need to enact massive fiscal tightening. They've still got a deficit of over 9, but left on its own, it could probably do it. It's just we don't live in that world. Spain's not in a vacuum. And all we are showing with our arithmetic is that all that needs to happen for Spain's fiscal position to become critical is for its interest rate, the effective rate it pays on its debt, to go from 4 to 6. And the salient fact I would leave people with is that this year, commercial Spanish banks need to roll over 5.5% of Spanish GDP. Next year, it's 9% of Spanish GDP. Add on to that what the government needs to do, and we're going to find out whether or not they really have decoupled.
It's remarkable, isn't it? Because if you look at the reaction in the markets right now, they seem to really be distinguishing between Spain and those smaller countries, because their borrowing costs seem to be just okay. But you're saying that they're actually underestimating the seriousness of the problem. But just one thing I wanted to pick up from your report, you're saying that growth will be increasingly driven by the US going forward. And speaking about debt in the Eurozone, how long before the markets start focusing on the US budget deficit and the lack of action, if you like, to bring that down?
Well, the US is going to secure its recovery first, and it has the luxury of being the reserve currency to enable it to do that. And in our view, we're starting to see some signs that the cyclical forces in America are starting to outweigh the structural headwinds, which is high and persistent unemployment and the housing market. In that environment, the US could raise rates much more quickly next year than the markets are currently anticipating, but they will only do so once they're absolutely certain recovery is entrenched. In our view, the ECB has moved well ahead of that recovery. Clearly, Germany is doing quite well, but it's a 16-nation bloc. And there are some parts of the Eurozone which are really, really struggling, and I think that situation will persist. So our medium-term call is the euro to fall quite sharply against the dollar over the next 12 to 18 months.
Danny Gabay, Fathom Consulting, good to talk to you.